Are you looking to master the art of reducing your tax liability while staying compliant with GST regulations? Today, we delve into the world of input tax credit, or ITC, and how businesses can leverage it effectively. By understanding ITC, you can unlock opportunities to optimize your tax savings. Claiming ITC isn't just about reducing costs, it's about smart financial management. Let's explore how you can navigate the complexities of ITC to benefit your business. Remember, mastering ITC is key to maximizing your tax savings and staying ahead in today's competitive market. Imagine a world where you could reclaim the taxes you pay on business purchases to offset your tax liabilities on sales. That's the essence of input tax credit, ITC. It's a strategic tool that prevents tax cascading, ensuring taxes are only paid on value additions. Picture it as a refund system. GST paid on inputs can be subtracted from what you owe on outputs. This principle maintains fairness and proportionality in tax obligations. By leveraging ITC, businesses streamline their tax burden efficiently. Ever wonder how the input tax credit system actually works in practice? It's a seamless flow of financial transactions starting with purchasing inputs, where businesses pay GST to suppliers. Then comes the crucial step of claiming ITC, where businesses credit the GST paid on eligible purchases. Selling outputs follows, as businesses collect GST from customers. Finally, it all comes down to the net payment, where businesses settle only the difference between output tax and ITC claimed. This systematic process ensures that tax is levied only on the value added at each stage, promoting efficiency and transparency throughout the supply chain. Ever wondered how manufacturers calculate their input tax credit? Let's break it down with a simple example. At the manufacturing stage, a company purchases raw materials worth 10,000 Indian rupees and pays 1,800 Indian rupees in GST. This amount becomes their input tax credit. When they sell the finished goods for 20,000 Indian rupees, collecting 3,600 Indian rupees in GST, their net tax payment is 1,800 Indian rupees after deducting the ITC. By only taxing the value they added, businesses avoid double taxation and stay competitive. Remember, it's about paying tax on what you contribute, not the entire sale price. Not all purchases qualify for input tax credit automatically. Specific conditions outlined in the GST law must be satisfied before claiming credit. Understanding and adhering to these requirements is essential for compliance. Why do some purchases not qualify for ITC? Because the GST law lays out precise criteria. For instance, the purchase must be used for business purposes and be properly documented. Failure to meet these conditions can lead to credit denial. To claim input tax credit, ensure purchases align with the criteria set forth in the GST law. This knowledge is key to maintaining compliance and maximizing credit opportunities. Do you know the 6 essential conditions for claiming input tax credit? First, you must possess a valid tax invoice with all GST-mandated details. Second, actual receipt of goods or services is crucial. Possessing an invoice alone won't suffice. Third, ensure the supplier has paid the tax to avoid credit reversal. Fourth, filing your GST returns is a must to claim ITC. Fifth, usage for business purposes is non-negotiable. Finally, steer clear of blocked credit categories as per Section 17(5) of the CGST Act. Remember, compliance is key for maximizing your ITC benefits. When reviewing an invoice, ensure all mandatory details are accurate. Verify the supplier's GSTIN, invoice number, date, recipient's details, goods/services description, quantity, value, tax breakdown, place of supply, and HSN/SAC code. Immediate verification is crucial to avoid later errors that could lead to denied ITC. Stay vigilant and meticulous in checking these essential invoice requirements. Ever wondered why you can't claim input tax credit on certain goods and services under the GST law? Section 17(5) of the CGST Act lays down clear restrictions, blocking ITC on specific categories, regardless of their business use. These measures are in place to curb misuse and ensure tax compliance on select items. In a bid to safeguard tax revenues, the law mandates this limitation, emphasizing the importance of adhering to the prescribed guidelines. It's crucial to understand these nuances to navigate the tax landscape effectively and stay compliant with the regulations. Navigating the complexities of blocked credits is essential for businesses seeking to optimize their tax positions and maintain financial stability. A clear grasp of these regulations can pave the way for smoother operations and enhanced tax planning strategies. In essence, being mindful of these restrictions is not just a legal requirement but a strategic move to safeguard your business interests and stay on the right side of the law. Ever wondered what types of credits get blocked in the GST system? Let's delve into the major categories. From motor vehicles, where ITC is restricted except for specific use cases, to food and beverages, beauty treatments, and personal items like club memberships, these are all no-goes for credit claims. Works contract services for property construction and purchases from composition scheme suppliers also fall into the blocked credit realm. Remember, understanding these categories is crucial to navigating the GST landscape effectively. Ever wondered which credits are eligible and which are blocked for your business? Let's dive into some examples. Eligible credits include essential items like raw materials for manufacturing, office supplies, business travel expenses, and utility bills for production. On the flip side, blocked credits encompass personal expenses like directors' cars, employee gym memberships, office pantry snacks, and building construction unrelated to production. Remember, claiming the right credits can make a significant impact on your bottom line. Choose wisely to maximize your benefits. Ever wondered how the invoice matching concept under GST impacts your input tax credit claims? Well, here's the deal. Your ability to claim ITC hinges on the accuracy of your purchase invoices aligning with your supplier's GSTR1 details. This meticulous matching process ensures that the taxes you're claiming credit for have indeed been handed over to the government. It's a crucial link in the GST chain, guaranteeing transparency and compliance. So, remember, in the realm of ITC, precision is paramount. Ever wondered how invoice matching streamlines the GST process? Your supplier files GSTR1, detailing your purchases by the 11th of the next month. This data seamlessly populates your GSTR2B, aligning your invoices. Next, you claim eligible credits in GSTR3B based on this information. The system then rigorously validates your claims against your supplier's filings on the GST portal. This automated process ensures transparency, accountability, and compliance, curbing tax evasion and guaranteeing only rightful credits are claimed. A streamlined approach for a fair and efficient GST ecosystem. Ever wondered how to decode the GSTR2B statement? Think of it as your key to unlocking available input tax credit. This auto-generated document, delivered by the 14th of the following month, is a static snapshot of your ITC universe, solely based on supplier invoices. It's your go-to for claiming ITC and detecting discrepancies, a crucial reconciliation tool. Regularly reviewing your GSTR2B ensures early error detection, enabling timely corrections with suppliers before filing. Stay sharp, stay ahead. Navigating through common mismatch scenarios in the realm of GST compliance can be a challenging feat for businesses. Picture this: you possess the invoice, yet the supplier has not submitted it in the GSTR1 form. Consequently, claiming input tax credit remains elusive until it reflects in your GSTR2B. Meanwhile, an incorrect GSTIN entry by the supplier could divert the credit to another entity. Swiftly urging the supplier to rectify this in their subsequent GSTR1 is imperative. Moreover, discrepancies in invoice amounts may stem from unaccounted debit/credit notes. Ensuring meticulous reconciliation is key to maintaining financial consistency. Lastly, beware of suppliers canceling registrations retroactively, rendering ITC on those invoices void, necessitating prompt reversal. Remember, vigilance and proactive communication are paramount in navigating these GST mismatch hurdles. Takeaway: stay vigilant and proactive in addressing common GST mismatch scenarios to safeguard your input tax credit eligibility. Have you ever had to give back something you thought was yours to keep? In the complex world of tax credits, ITC reversal demands just that, returning claimed credits. Picture this: you benefited from the credit, but circumstances change, and now it must be returned. Maybe the goods or services weren't used as intended. It's a crucial step when eligibility criteria aren't met anymore. Precision is key. One misstep can trigger a reversal. Stay vigilant, as compliance is paramount. Remember, claiming ITC is a privilege that comes with responsibilities. It's not just about gains, it's about accountability. Have you ever wondered when input tax credit needs to be reversed? Let's dive into specific scenarios. Firstly, if business assets are used personally, a proportionate ITC reversal is necessary. Then, failing to pay suppliers within 180 days requires reversing claimed ITC with interest. Additionally, ITC linked to exempt supplies must be reversed when common inputs are utilized. If goods are lost, stolen, or destroyed, except in cases of natural calamity, ITC must be reversed. And when receiving a credit note for returned goods, corresponding ITC needs to be reversed. Lastly, any change to non-business use of capital goods post-ITC claim mandates a proportional reversal. These guidelines ensure accurate ITC management and compliance. Remember, timely and correct ITC reversals maintain financial integrity. Ever wondered how to handle ITC reversals for mixed supply usage? Let's dive into an example. Imagine a company buys office supplies for Indian rupee 118,000, using them 70% for taxable sales and 30% for exempt sales. Initially claiming full ITC of 18,000 Indian rupees, they must now reverse 5,400 Indian rupees attributed to exempt supplies. This leaves them with 12,600 Indian rupees of net ITC available for use. Remember, timely reversal and accurate reporting, like in Table 4b of GSTR 3b, are crucial for compliance. Ensuring proper ITC calculations prevents compliance issues and ensures accurate tax reporting. Are you maximizing your input tax credit effectively? To ensure smooth operations, follow these best practices for ITC management. Prevention is key. Verify supplier extends, detail invoices, segregate expenses, and track payment deadlines. For reconciliation, review GSTR 2B monthly, compare data, resolve mismatches promptly, and maintain records. Stay compliant, file returns on time, reverse ineligible ITC, pay interest if delayed, and conduct internal audits regularly. Stay ahead in managing ITC for a seamless financial flow. Are you jeopardizing your ITC claims? Claiming without receipts, ignoring blocked credits, and not reconciling GSTR 2B can lead to penalties and interest. Delaying reversal or lacking proper documentation can result in credit denial during audits. Remember, time limits are crucial. Missing the deadline means a permanent loss of credit. Stay vigilant and ensure compliance to maximize your ITC benefits. One-liner takeaway: avoid these common ITC mistakes to safeguard your financial interests. Welcome to the final slide where we master ITC compliance. It's crucial to know the basics. ITC reduces tax liability but comes with strict conditions. Meet all requirements, match invoices regularly, and avoid blocked credits. Remember to reverse ITC when needed and maintain meticulous records. Maximizing legitimate ITC is an art of detail, reconciliation, and timely action. Start with these fundamentals for a solid GST compliance foundation. Take charge, stay compliant, and safeguard your business.